Have you ever wondered why some people seem to get richer with ease, while others struggle financially their entire lives despite working hard? Welcome to this summary of the groundbreaking book, Rich Dad, Poor Dad by Robert Kiyosaki. I'm Mac, and I'm excited to take you through the ideas that have changed millions of lives around the world, including my own. At its core, this book contrasts two powerful influences in Kiyosaki's life: his biological father, a highly educated but financially struggling professor. He calls Poor Dad, and his best friend's father, a self-made millionaire with little formal education, his rich dad. Through their contrasting approaches to money, Kiyosaki unveils profound lessons about wealth that schools never teach us. You will discover why traditional financial advice like work hard, save money, and climb the corporate ladder might be keeping you trapped in what he calls the rat race. Over the next 30 minutes, we will explore why financial education matters more than your salary, why buying a house might not actually make you rich, and most importantly, how to start building wealth regardless of your current income. Whether you are just starting your career running your own business or dreaming of financial independence, these principles apply universally. So let's begin this journey to financial freedom together. Part 1. The Two Dads Mindset Difference. The most fascinating aspect of Kiyosaki's story is the contrasting mindsets of his two father figures. His biological father, Poor Dad, was highly educated with a PhD and worked as a school superintendent. He valued traditional education, believed in job security, and followed the conventional path: study hard, get good grades, find a secure job with benefits, and save for retirement. Whenever young Robert wanted something expensive, Poor Dad would say, "We cannot afford that," or "money does not grow on trees." He worked hard his entire life, but struggled financially despite his impressive credentials. Rich Dad, on the other hand, never finished high school, but owned multiple businesses, restaurants, construction companies, and real estate. He thought differently about money. When his children wanted something, instead of saying, "We cannot afford it," he would ask, "How can we afford it?" turning each desire into a creative thinking exercise. While Poor Dad worried about job security and steady paychecks, Rich Dad focused on creating systems that generated wealth without his constant presence. He was not the most educated person in the traditional sense, but he understood how money works. And this is the first major lesson. It's not how much money you make that matters. It's how you think about money. Poor Dad would say, "Study hard so you can find a good company to work for." Rich Dad would say, "Study hard so you can find a good company to buy." One dad focused on earning a salary, the other focused on acquiring assets and building systems. One worked for money, the other made money work for him. This fundamental difference in mindset is what separates those who will always need to work for money from those who will eventually have money working for them. Part 2. The Importance of Financial Education. Here's a question that might surprise you. What subject is completely missing from most school curriculums worldwide, yet affects every single person every day of their lives? The answer is money management, financial literacy. We spend years learning about history, literature, and advanced mathematics, but receive almost no education about investing, taxes, debt management, or building wealth. As Kiyosaki puts it, the lack of financial education in schools is what creates the risk, not investing itself. Poor Dad believed that good grades and specialized knowledge were the paths to financial security. Rich Dad understood that specialized knowledge alone will not make you wealthy. You need broad financial knowledge regardless of your profession. Let me share a simple example Kiyosaki uses in the book. Imagine two neighbors with similar jobs, incomes, and families. Both buy identical houses on the same street. One sees the house as his biggest asset. The other sees it as his biggest liability. 20 years later, their financial situations are dramatically different, not because of their incomes, but because of how they understood what they were buying. This is why Rich Dad insisted, the single most powerful asset we all have is our mind. If trained well, it can create enormous wealth. Financial education is not about getting rich quick. It's about understanding the language of money, knowing the difference between assets and liabilities, understanding cash flows, recognizing investment opportunities, and making your money multiply. Without this education, even high-income professionals like doctors and lawyers can work their entire lives and still struggle financially. They earn a lot, but lack the knowledge to keep and multiply what they earn. The good news, financial education is accessible to everyone. Rich Dad started teaching Kiyosaki these principles when he was just 9 years old, through simple games and real-life experiences. It's never too late or too early to start learning. Part 3. The Rat Race and Escaping It. Picture this: you get a raise at work. Exciting, right? But within months, your expenses mysteriously rise to match your new income. You buy a nicer car, move to a better neighborhood, upgrade your lifestyle. Soon you are working just as hard, but still living paycheck to paycheck, just with nicer stuff. This is what Kiyosaki calls the rat race, the endless cycle of working, earning, spending, and remaining financially dependent on your next paycheck. Poor Dad was trapped in this cycle his entire life. Despite his impressive education and steady job promotions, he always seemed to need more money. His advice reflected this mindset: go to school, get good grades, find a secure job with benefits, save a little each month, and work your way up the ladder. It sounds reasonable, does not it? It's what most of us have been taught. But Rich Dad saw a fundamental flaw in this approach. He would say, the conventional approach means you will be working hard for money your entire life. The wealthy don't work for money. They make money work for them. The rat race looks like this. You work hard, earn money, pay bills, buy liabilities that look like assets, and then repeat the process month after month, year after year. But what happens if you lose your job, get sick, want to retire? Without your labor, the income stops, and the fragile system collapses. Rich Dad proposed a different path. First, understand the difference between assets and liabilities. Second, acquire assets that generate income. Third, use that income to buy more assets. Fourth, eventually, your asset income exceeds your expenses. Fifth, at this point, you have escaped the rat race. This is not about getting rich overnight. It's about building a foundation of assets that generate income, whether you work or not. Imagine waking up knowing that even if you didn't work that day, money would still flow into your accounts. That's not retirement, that's financial freedom. And according to Rich Dad, that freedom is available to anyone willing to learn and apply these principles. Part 4. Assets versus liabilities. Here we come to what Kiyosaki calls the most important lesson in the entire book. The rich buy assets. The poor and middle class buy liabilities they think are assets. So, what exactly is the difference? Rich Dad's definition is beautifully simple. An asset puts money in your pocket. A liability takes money out of your pocket. That's it. It's not about how expensive something is, or how much it might be worth someday. It's about cash flow. Does it generate money for you, or does it cost you money? Let's look at some examples. A rental property that brings in more monthly rent than it costs in expenses. That's an asset. Your personal home that requires mortgage, payments, property taxes, maintenance, and utilities. That's a liability. Stocks that pay regular dividends. Assets. A car that depreciates and requires insurance, fuel, and maintenance. Liability. A small business that generates profit without your daily involvement. Asset. Credit card debt. Definitely a liability. This definition challenges conventional wisdom. Most people consider their home their greatest asset. But Rich Dad would disagree. If you are paying more for your mortgage, taxes, and maintenance than you would to rent a similar place, your home, is draining your wealth, not building it, regardless of its market value. Here's a story from Kiyosaki's experience. His poor dad always encouraged him to buy the biggest house you can afford, because your house is an investment. Meanwhile, his rich dad would say, "My house is a liability, and if your house is your largest investment, you are in trouble." The wealthy follow a simple pattern. They buy assets first. These assets generate income. They use this income to fund their lifestyle and buy luxuries. The middle class, by contrast, buy liabilities first, like expensive homes, cars, clothes, and then struggle to acquire assets with whatever money is left. This is not about living like a monk. It's about sequence. Buy assets first. Let those assets generate income. Use that income to fund your lifestyle, including the nicer house and car, if that's what you want. But assets come first. Imagine two paths. First, salary expenses, investments with what's left. Second, salary investments, additional income expenses. The second path leads to financial freedom, and it all starts with understanding this crucial distinction between assets and liabilities. Part 5. Work to learn, not to earn. When Kiyosaki graduated from college, poor dad was proud and excited. "Now you can get a good job with a solid company," he said. Rich dad had a completely different reaction. "Now you can learn how business really works." This highlights another crucial difference in mindset. Poor dad believed in specialization, become an expert in one field, climb the ladder, earn promotions and raises. Rich dad believed in generalization, learn a little about a lot, especially when it comes to money and business. After college, Kiyosaki joined the Marines and then worked for Xerox, not because he wanted a lifelong career there, but because they had an excellent sales training program. He was terrible at sales initially, but he persisted because he knew this skill would be invaluable for his future. As Rich Dad told him, "If you want to be rich, you need to know how to sell." While his colleagues focused on commission checks, Kiyosaki focused on learning skills. How to overcome fear of rejection, how to communicate effectively, how to build systems, how to lead teams, how to market product. Rich Dad's advice was clear. Work to learn, not to earn. This applies regardless of your career path. A doctor who understands investing can multiply her earnings. A teacher who knows marketing can create educational products that reach thousands. A skilled tradesperson who understands business systems can build a company instead of just selling his time. This does not mean your specialized skills are not valuable. It means complementing them with financial and business knowledge creates exponential rather than linear growth. Consider this. If you are an employee with great technical skills but no financial education, your options are limited to earning a higher salary. But if you combine technical expertise with financial knowledge, you could potentially invest your earnings strategically. Create and sell products based on your expertise. Build a business system around your skills. License your knowledge. This is true financial synergy, where the combination of skills becomes more valuable than each individual skill. So ask yourself, are you working just for today's paycheck, or are you acquiring skills that can generate wealth long into the future? Part 6. The Power of Entrepreneurship and Investing. When Kiyosaki was a teenager, Rich Dad explained that there are fundamentally different ways to earn money, and not all are created equal. He described what he called the 3 types of income. First, earned income money you work for, like salaries and wages. This is the highest taxed and most time-intensive form of income. Second, portfolio income money from paper assets, like stocks, bonds, and mutual funds. This can be powerful, but often requires substantial capital to generate meaningful returns. Third, passive income money that flows whether you work or not, typically from real estate royalties or business systems that don't require your presence. Rich Dad explained that most people focus exclusively on earned income, working harder and longer to make more money. But the wealthy understand that true financial freedom comes from building substantial portfolio and passive income. Let's think about this practically. If you earn $100,000 from a job, you trade approximately 2,000 hours of your life each year for that money. If you stop working, the money stops. But if you earn $100,000 from real estate investments or businesses you own, that money flows, whether you are working, sleeping, or on vacation. Your time is liberated. This is why Rich Dad emphasized entrepreneurship and investing. He believed the path to wealth was not just about having a high-paying job, but about owning income-producing assets. Kiyosaki shares a personal example. In his 30s, he started a small business creating nylon and Velcro wallets. While the business eventually failed, the experience taught him invaluable lessons about manufacturing, international business, and building systems. He then applied these lessons to real estate investing. Instead of looking for a nice place to live, he searched for properties that would generate positive cash flow from day one. While his friends bought homes that drained their bank accounts, each month he acquired rental properties that deposited money into his account monthly. This exemplifies Rich Dad's approach. Don't work for money. Have money work for you. Anyone can begin this journey. It might start with a small investment in dividend-paying stocks, a side business run on weekends, or studying real estate in your local market. The scale can be small at first. What matters is shifting your mindset from employee to investor and entrepreneur. Part 7. Mind over money, overcoming fear and risk. I'm afraid of taking risks. What if I lose money? Investing is too complicated. I don't have enough money to start. Kiyosaki heard these objections constantly. Even his poor dad, highly intelligent and educated, avoided investing because he feared losing money. Rich Dad had a different perspective. Fear is the primary emotion when it comes to money. The key is not avoiding fear, it's managing it. He taught Kiyosaki that there are two kinds of risk. One, blind risk, gambling your money without knowledge or strategy. Two, calculated risk, making informed decisions based on education and experience. Most people avoid all financial risk because they don't know the difference. But Rich Dad insisted risk comes from not knowing what you are doing. The more financial knowledge you have, the less risky money becomes. This explains why some people panic during market downturns while others see opportunity. Why some view real estate as terrifyingly complex while others build fortunes through property. The difference is not luck or natural talent, it's financial education. Kiyosaki shares a personal story about his first real estate purchase, a small condo in Hawaii during a market recession. Everyone told him he was making a mistake. The market was terrible. He could lose everything. But he had studied the market, understood the neighborhood dynamics, and calculated the potential rental income. He was nervous, but educated. That risky purchase generated positive cash flow from the first month, and eventually appreciated substantially. Rich Dad taught him failure is part of success. People who avoid failure also avoid success. This does not mean being reckless. It means recognizing that financial growth requires stepping out of your comfort zone with knowledge as your safety net. So how do you start overcoming financial fear? 1. Begin with education before investment. Read books, take courses, find mentors. 2. Start small. Your first investment should not be your life savings. 3. Learn from each experience. Both successes and failures provide valuable data. 4. Increase your investments as your knowledge grows. Remember, Rich Dad's wisdom. The biggest risk of all is not taking one. Playing it completely safe, keeping all your money in a low-interest savings account, for instance, is actually risky in a different way. It's the risk of watching inflation erode your purchasing power over decades. Financial courage is not the absence of fear. It's moving forward despite that fear, armed with education and a long-term perspective. Part 8. Taking action and building your asset. Knowledge without action is merely entertainment. So how do you begin applying these principles in your own life? Rich Dad gave Kiyosaki a simple starting point: mind your own business. By this, he did not mean being private or secretive. He meant literally start building your own business, your asset regardless of your current profession. Your profession generates your income, but your business, your assets, creates your wealth. Here's a practical roadmap to start building your asset today. Step 1. Get clarity on your current financial situation. Track all your income and expenses for at least 1 month. Identify which expenses are truly necessary and which are wants. List everything you own, and honestly categorize each as an asset or liability. Using Rich Dad's definition, does it put money in your pocket or take money out? Step 2. Pay yourself first. Before paying bills or discretionary expenses, set aside a percentage of your income specifically for acquiring assets. Treat this as your most important bill, non-negotiable, and paid before anything else. Step 3. Start small, but start now. You don't need a fortune to begin building assets. Consider entry-level investments like dividend-paying stocks or ETFs, education to develop marketable skills, small real estate investments, side businesses that could eventually run without your daily involvement. Step 4. Increase your financial IQ through practical experience. Each investment is not just about the money, it's about the learning. Analyze what works and what does not. Gradually increase your investment size as your knowledge grows. Kiyosaki shares how he started setting aside $100 per month to invest while still working full-time. His first investments were small, and he made plenty of mistakes. But each experience, successful or not, built his financial intelligence. He emphasizes that the goal is not perfection, but progress. Rich Dad taught me that financial freedom isn't about getting everything right. It's about getting started and learning through real-world experience. For some, this might mean investing in dividend stocks. For others, starting an online business or buying a small rental property. The specific vehicle matters less than the fundamental shift from consumer to investor. The key is consistency. Financial wealth is not built through one brilliant investment, but through the steady accumulation of assets over time. As Rich Dad would say, don't work for money, work for assets. Part 9. Cashflow Quadrant Preview. While Rich Dad, Poor Dad focuses on mindset and foundational concepts, Kiyosaki introduces another powerful framework in his follow-up book called the Cashflow Quadrant. This concept is worth understanding as it provides a roadmap for your financial journey. Imagine a square divided into 4 quadrants, each representing a different way of generating income. Employee. You have a job and work for someone else. S. Self-employed. You own a job, essentially working for yourself. B. Business owner. You own a system that generates money without your constant presence. I. Investor. Your money works for you through various investments. Most people spend their entire lives in the quadrant, working for corporations, governments, or other organizations. Some advance to the S quadrant, becoming self-employed professionals like doctors, lawyers, or consultants. While these transitions can increase income, they don't necessarily create financial freedom. Why? Because in both the E and S quadrants, if you stop working, the money stops flowing. Rich Dad emphasized moving to the right side of the quadrant, becoming a B business owner or I investor. These positions generate income whether you are actively working or not. A business owner builds systems and hires people to run those systems. Think of franchise owners or entrepreneurs who can take a month off while their business continues operating. An investor puts money to work in assets that appreciate or generate cash flow, real estate stocks, bonds, business investments. Rich Dad's path to wealth was not about earning a higher salary, but transitioning from the left side of quadrant E and S to the right side, B and I. This framework helps explain why some high-income professionals still struggle financially. A doctor making $300,000 in the S quadrant might have less financial freedom than a business owner earning $150,000 in the B quadrant because the doctor must keep working to maintain her income. Understanding the cash flow quadrant gives you a strategic vision for your financial journey, not just increasing income, but changing how that income is generated. Conclusion. As we reach the end of our journey through Rich Dad, Poor Dad, let's reflect on the powerful lessons we have explored. First, your mindset shapes your financial destiny. The way you think about money, whether you see opportunities or obstacles, whether you approach challenges with curiosity or fear, will ultimately determine your financial outcomes more than your income. Second, the difference between assets and liabilities is crucial. Remember Rich Dad's simple definition: assets put money in your pocket, liabilities take money out. Focus on acquiring assets first, then using the income from those assets to fund your lifestyle. Third, financial education is your most powerful tool. The more you understand about money, investing, business, and markets, the more opportunities you will recognize and the fewer risks you will face. Fourth, work to learn, not just to earn. Develop skills that increase your earning potential and financial intelligence rather than just chasing paychecks. Finally, taking action is what separates those who dream about financial freedom from those who achieve it. Start small if necessary, but start now. As Kiyosaki's Rich Dad would often say, the rich don't work for money, they make money work for them. This does not mean money is the most important thing in life. It means that understanding how money works gives you choices, the choice to pursue meaningful work regardless of salary, to spend time with loved ones, to contribute to causes you care about, and to live life on your own terms. Your next step. Choose one principle from this summary and apply it this week. Perhaps track your expenses and identify your true assets and liabilities. Maybe set aside a small percentage of your income specifically for investments, or dedicate time to increasing your financial education through books, podcasts, or courses. Financial freedom is not achieved overnight, but every journey begins with a single step. Thank you for joining me for this exploration of Rich Dad, Poor Dad. May your path to financial intelligence be rewarding not just financially, but in the freedom and choices it creates in your life.